The housing market is facing some major headwinds, and unfortunately, it's only going to get tougher from here. Now, I'm not saying the sky is falling, but with rising mortgage rates, inventory issues, and the economy slowing down, we're not likely to see a rebound anytime soon. In this video, I'm going to break down the 5 key factors that are putting pressure on the housing market, along with sharing some tips to find opportunities even when the market looks bleak. Now, let's get real. I've been a big proponent of the housing market for the last 4 to 5 years. In fact, I was one of the few real estate agents out there on YouTube back in 2020, 2021, 2022, and 2023 telling you that the housing market wasn't going to crash. And while I still believe that to be the case, everyone is starting to feel a bit of the squeeze now. And for the longest time, it was kind of the buyers feeling the majority of that pressure. But now, sellers are starting to feel it too. So I want to take a little bit of time here and actually talk about what's putting some downward pressure on the housing market and why it could be a little while before we start to see the housing market pick up again. Let's start with inventory, because if you've been shopping over the last couple of years, you know that inventory has been a huge problem in the market. In fact, inventory is usually the tail that wags the dog. And by that, I mean if you have a lot of inventory out there in the market and you don't have a lot of buyer demand, then typically that's a softer market. That's more of a buyer's market. And honestly, more of what we're seeing at the moment. For the last couple of years, inventory has been really low in most major markets out there. And because of lower interest rates pulling buyer demand forward, along with the largest cohort of buyers, millennials, starting to turn prime buying age during that same period of time. And because demand outweighed supply, we saw house prices increase about 50% over the last 5 years. But if you've been paying attention and starting to look at the market now, you've probably noticed a lot more options. And the primary reason for that is because the market is largely impacted by the lack of housing affordability at the moment due to higher interest rates and higher home prices. And because of this, homes are sitting on the market longer, inventory is growing, and because of that, sellers really have 2 options. They either do some sort of price reduction, which nearly 40% of the listings on the market have at the moment, or you in turn pull that home off the market and wait for a better time to sell, which is exactly what we're seeing at the moment. Now, the second thing that's factored into there is buyer demand. And because home prices have stayed high, rates have moved back up, along with people just unsure about the economy, unsure about the presidency, and what that actually means for housing. Buyer demand has been shaky and they're now holding back. But here's the thing, that wasn't the case just a couple of weeks ago when interest rates moved to the lowest levels that we had seen in nearly 18 months. In fact, it was just reflected in the latest pending home sales, up over 7%, which is the highest level that we've seen since March, and up 2.6% over September of last year. So we know as mortgage rates move lower, it's likely to create more buyer demand in the market, which in turn translates into more home sales. But unfortunately, we have mortgage rates rising, and that's the third factor that I want to talk about. Interest rates are currently sitting at the highest level that we've seen in nearly 4 months. And with that, we've probably seen the largest climb in mortgage rates over the last 6 weeks than we have in the last couple of years. As you can see from this chart here, back on September 11th, the rate on a 30-year fixed mortgage was sitting at 6.11%. Now, rates did get as low as 6.02%, but unfortunately, I don't have a picture of that. I didn't clip that one. But as you can see, since then, mortgage rates have climbed to over 7% as of the time I'm filming this video, which when you look at it on a $500,000 loan, that's a difference of $300. Now, at the moment, there's a 100% probability that the Fed is going to cut at their next meeting. But unfortunately, I don't think it's going to have any positive impact on mortgage rates. And the reason for that is because I believe it's already built into the market. If you take us back a couple of weeks ago, prior to the last Fed meeting, interest rates were sitting at the lowest level that we had seen in nearly 18 months. And there was this expectation in the market that as the Fed cut, that we would in turn see mortgage rates move even lower. But as I said at that time, the Fed has been very transparent about what they want to do. Therefore, the market has probably already front-run this and built it into where mortgage rates are at this time. And that's part of the reason that you saw mortgage rates go up after the Fed meeting, in addition to some other economic news, which we're going to touch on here in just a minute. But here's the thing, if you look at the Fed probability of cutting rates in the future, you can see that there's already an 83% chance that they're going to cut again in December. On top of that, they're pricing in 3 additional cuts for 2025. And while this is positive for the bond market and mortgage rates, the reality is this policy is still super restrictive, which means the next few cuts probably aren't going to really do much when it comes to improving mortgage rates. And the reason for that is because it largely has to do with factor number 4, which is the economy. Ever since the last Fed meeting, once they cut 50 basis points, the market has essentially been gangbusters when it comes to the economy. And positive news, with the job numbers from September coming in better than expected, unemployment actually dropping, along with core PCE coming in higher than expected, and consumer confidence rising 11%, which is its biggest single month acceleration since March of 2021. And while we have seen job openings slide to 7.44 million in September, which is the lowest level that we've seen since January of 2021, and non-farm payrolls coming in way less than expected, only generating 12,000 jobs in October and well below the Dow Jones estimate of 100,000, we've actually seen mortgage rates move higher. And that's partly due to the fact that the economy looks really strong on paper, which leads a lot of people out there to believe that the Fed's not going to have to cut quite as much as they had originally anticipated. And better yet, that we're headed for this soft landing, or no landing at all, if you will, because the economy looks really strong. And because of that, mortgage rates are likely to stay higher for longer. Now, early in the year, I had forecasted that interest rates would probably be sub 6 by the end of the year. And while we did see interest rates go briefly under 6% for well-qualified buyers out there just a couple of weeks ago, those same borrowers today are somewhere in the high 6% range. And unfortunately, not likely to see those same rates until we see a way softer economy. Now, with the first 4 factors that we've talked about, inventory, demand, interest rates, and the economy weren't enough to slow down the housing market going forward, you got to throw in the 5th one, which is seasonality. And unfortunately, this is the time of year when things naturally slow down anyway. Once you move towards the end of the year, you get the holidays coming, that generally means a slower housing market. And unfortunately, this year, it's likely to be amplified by the current market conditions. So what does that actually mean? It means homes are likely to sit on the market even longer than they normally would in this time of year because of higher rates, because of less buyer demand, because of growing inventory. All of these things are going to play a part, which means some sellers are just going to pull their homes off the market like we discussed earlier, while others are going to have to lower their home prices if they have to sell for some reason. Some people have to sell because they need to do something by the end of the year. Some people have already purchased another home and they need to sell one. Some people are contingent. They're already in contract on another property and they need to sell property A to buy property B. And that's what I always tell clients. If your home is on the market right now over the next couple of months, that likely means that you're a real seller, that you need to sell that home. Otherwise, you would pull that property off and wait for the spring market when things are likely to be a little bit more normal than they are right now. But at the same time, I also feel like that's where the best opportunity lies. If you're somebody that's looking to buy a house right now, you're well qualified, the payment makes sense to you, it's the right time in your life, you have that longer term time horizon, now might be the best opportunity to take advantage of somebody that needs to sell a property, especially if it's been sitting on the market for an extended period of time. Now, I know what you're saying. That's a typical answer from a real estate agent. It's always a good time to buy a house. Hold up. Now isn't a great time to buy a house unless you can find that opportunity, unless you've been looking for a specific type of property over the last couple of years and you haven't been able to find it and now it pops up. Then it could be a good time. At the same time, if you're looking to fix your housing costs with the idea that mortgage rates might continue to move higher, that home prices might continue to move higher, and if rates move down in the future, you can take advantage of them at that time by refinancing, assuming you qualify. Just remember, when things slow down is when some of the best opportunities in the market are found. And that's because as a buyer, you have more leverage in the market. When things are all grand for sellers, homes are selling really quickly, and as a buyer, there's a lot of competition out there in the market, well, the sellers don't need to reduce prices. They don't need to do anything to get their home sold. Well, things have flipped now, and the market is slowing down. Buyer demand is down. Inventory is up. Rates are up. Affordability is sitting at some of the worst levels that we've seen in quite some time. And now is a prime opportunity to take advantage of it if you are a buyer, with the expectation that as things improve in the future, that you're going to be able to lower that payment. But here's something I want you to remember. Not only is real estate local, real estate is a long-term game. In fact, if you look at this chart here over the last 40 years, you can see what home prices have done across the United States. Now, something I want you to notice here, none of them are negative. In fact, the lowest level of appreciation that we've seen over that 4-year period of time is almost 200%, with the highest level being over 800%. But at the moment, inventory is growing, buyer demand is dropping, rates are moving higher, the economy is uncertain, and we're in the middle of a seasonal slowdown, which means the market is primed to get worse before it gets better. But also remember, some of the best deals and opportunities out there in the market come when others are sitting it out. But I'd love to know your thoughts on what's happening in the market at the moment and what you think the next year holds. Do me a favor and let me know in the comments below.